Thank you, Gordy, and thank you, Dave. Great presentations. So look, we'll now open up for questions, and if we have any callers on the line, maybe if they could introduce themselves and then the question. So do we have any questions?
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. The first question comes from Andrew Steele with Jarden. Please go ahead.
Andrew.
Good morning, guys. The first one from me is on your thinking about development planning and I guess phasing. I mean, you've said that you have no intention at this stage of starting off any new projects in this year. Yeah, if circumstances were to change, which style of projects would you be looking to accelerate or potentially decelerate, depending on market conditions, and within that, thinking about deploying incremental capital in the Victorian market versus the New Zealand market, do you have a preference at this stage from a risk perspective?
Yeah. Oh, thanks for that question. So with the 12 sites that we've got on the go going into the next year, there are 2 new villages that we're committing to. Riccarton Racecourse, which we're just starting. In fact, Andrew Inch, who's going to be our project manager, I saw him here a couple of days ago. He was recruiting people. So they're sort of busy getting underway at the site there. The second one is Ocean Grove, which is down the Bellarine Peninsula in Victoria. And we're just really waiting for the final dots and crosses to be signed on the endorsed plans from council. We've got the development approval, we're just getting the endorsed plans done, which is like the equivalent of the building consent for the entire site. So those discussions are going well. And that is a site we expect to be our 5th village open in Melbourne by 31 December 2020. So in terms of other sites though, I think it's probably better for us to just sort of take a read on the market. There's actually a number of sites we could start on. For example, we've got a consent for Coburg, we've got one for Hyatt. We'll have other sites that come through that might come quicker through the 7 that we've got in the pipeline, for example. And look, we'll just have to take them on a case-by-case basis, Andrew, depending on how we travel. But we think that a spread of 12 sites, which we have under really good control, the ones we've been building out for a while now, we've got a really good sense of all the timings and demand. And the 2 new sites we're adding in have a greater proportion of townhouse elements to them, so they won't require quite the same capital commitment moving into them. So we think that's about the right sort of balance. When we looked at the sort of sales for the year ahead, if we get slightly more sales than we expect at some of those sites, we can quite easily turn on another couple of stages, and that's why, speaking with the board last week at our meeting when we caught up, I think there is a potential to flex between sort of 900 and 1,000, but it's early days yet, so I would really take 900 as where we're targeting to be.
Thanks, Gordy. And just two follow-up questions on that. The first thing, given the flex in the pipeline of, you've highlighted between 900 and 1,000 beds and units, is there sort of a flow-on impact into the following year? And can you sort of get back to sort of the pre-COVID trend if you wanted to in terms of build rate, or is it sensible to expect that it will be lower?
No. Look, Dave hates it when I answer these questions, but I'm going to anyway. Look, we would want to do 900 this year. It's possible we could do more. In the year ahead, it's very much possible we could do in the region of 1,300. As we lift our build rate in Victoria and as we get some good site underway in New Zealand, which have good momentum. So our overall plan, Andrew, is to continue to lift our build rate in Melbourne and Victoria to match the historic build rate in New Zealand. It's, roughly 800 on each side. And I guess to slightly tip a hat to your question, which is our favourite nation, well, we love them both. but there may be opportunities that turn up in Victoria and we decide to do some more there for a period of time, or vice versa. So we've got some really good options, and we're lifting our build rate, and my goal would be that we would still get back to the 800 per country type target that we were hoping for a couple of years ago, actually.
I think, Andrew, maybe part of your question is,
Okay,
are we going to
thank you.
pivot?
And-
Are we going to pivot towards Australia? And that really isn't a decision we've taken. I think we'll be driven more by demand and what opportunities come up. And, you know, given the environment we're in now, there will be opportunities around land acquisition that we will have to look at closely. So, yeah, we need to sort of stay reasonably agile around that.
The main thing really actually is that we're getting great feedback from residents in both countries. So we've got a lot of confidence from which to build from, and as Dave said earlier, we've got a really substantial forward order book, so we're chafing to get back into it, and we are.
Another question?
Great, thanks, guys. And just one last one related to that. You know, given these updated development expectations, you know, what can you give some sort of sense as to, you know, how you think development CapEx, how much development CapEx might be for this year?
Yeah, look, we don't normally give development CapEx sort of forecasts, but I would expect it to be less than what it was this year. It might be in the sort of the fives, and that would hopefully be with actually more units and beds delivered. And that really reflects the fact that we've done a lot of pre-civil works and preliminary works at a number of other sites. So I guess it's just getting a bit of advantage from that.
That's great. Thank you very much, guys.
Thank you. The next question comes from Stephen Ridgewell with Craigs. Please go ahead.
Good morning. And first of all, credit to the team at Ryman for the way you've protected residents during the pandemic. I think it's clear, you know, the company's been a world leader in this area, so well done to you all. Just in terms of my questions, actually, Andrew's asked a few of them, but in terms of recent trading,
Reggie, can we just
mentioned 150.
Sorry, Reggie, can you hear me?
Oh, yes?
Yeah. Can we come back to you? We just have a really bad line, so we might just jump to one more call and then come back, if that's okay.
Or just try and speak.
Or do you just try now, just really slowly?
Okay, sure.
Just speak really slowly and loudly. Let's try that.
Okay. So can you hear me now?
Yeah.
Yep.
Yeah. Go for it.
Okay. So I'm not sure if you heard anything that I said before, but I'll start again. So, David, you mentioned resales were 131 units, I think it was, for resales since May, and that's up on last year. Are you seeing new sales improve also? And perhaps could you split, are you seeing any different trends between the New Zealand and Australian businesses?
We're really seeing resales as the first ones out of the blocks, because as you can imagine, Reggie, from a resident point of view, it's nice being able to see a fully completed mature village, and it's something that people can look at quickly and have that confidence. I think for new sales, we're starting to see new sale transactions absolutely occurring in the last sort of couple of weeks particularly, and we've got great sites with stages coming on. So the build program is really important to initiate again, because we've got $336 million of unconditional sale contracts where residents are keen to move into our villages, and they've really worked with us during COVID delays and so on. And I think for other prospective residents, they're going to enjoy seeing the building teams, being recommenced. And I suspect it might just take sort of another few weeks for new sales to pick up at the same sort of rate, actually.
Yeah, and I think on that, Reggie, you saw the value of the needs-based sort of portfolio, because in the first sort of couple of weeks as we came out of level 4, the demand for our service apartments was really strong, and the independents have caught up on the resale front in probably the last couple of weeks. So I think we'll see the same with the new sales now, as Gordy said. but it just shows that that good mix of portfolio is important.
Yeah, and Australia transactions are coming through. They're still in a bit of a tougher lockdown than we are actually. So they're still getting a few cases each day and that sort of thing. So, but our teams are absolutely transacting with people, and the villages, got good vibrancy back again. So they can very much see that things are changing for the better in Victoria as well.
So, Stephen, I imagine that part of it is that the resales will be to people whose health need or care needs are highest and they can't delay, and so they will transact more rapidly. Whereas if you're looking at a building that may not be completed for 2 or 3 months, that's potentially a different market. So you can imagine that the resales will be potentially higher need residents.
That's helpful, thanks. And, also, we're seeing some operators offer, promotional terms, if you like, deferred settlements or fee discounts. Is Ryman offering those sorts of promotions at all, or can you talk us through what any particular incentives you're offering or plan to offer to get activity going again?
Yeah, what we're doing, Stephen, is offering a set of terms and conditions that are market leading. So, for example, my perspective is, let's start with deferred management fees. Our deferred management fees are capped at 20% for your life in the village as a resident. Now, I think in a situation where there's financial pressures on families and other people, that some deferred management fees are different by, say, 5 or 10%. If you apply that to, say, an $800,000 unit, people need to ask questions about what does that extra $80,000 deliver. And so I think those sort of questions will be scrutinised more closely in these sort of times. And so our Ryman Peace of Mind guarantees around a lower deferred management fee, a fixed weekly fee for life, no one's ever waited more than 6 months to be repaid, and those sort of things. Our terms really stand out. And the second thing is that obviously with the large-scale care centres that we have, throughout COVID we've been able to offer people a huge amount of peace of mind and very, very high quality care, probably during the most trusted environment we've ever experienced, where family couldn't see their loved ones for a number of weeks. And that is a very high trust environment, and the feedback we've had has been great. So I think that over COVID we have been able to build closer relationships with families and our residents, enhance our brand. We already have what I would view as leading terms in the sector, and so that's the basis on which we're going to market.
Okay, no, that's helpful. Just on, Andrew's already asked a few questions on CapEx plans, but just in terms of new site acquisitions, it was interesting to see the site announcement on Tekapuna today, just given the context of the environment we're in. Was that a deal that was, if you like, cemented a few months ago before COVID, or was that a relatively recent agreement? And should we read that as Ryman's going back in the market for new?
Yeah, look, we were delighted to buy that site, Stephen. I guess the only thing that you could ever argue about if it's in a pre or post-COVID environment is, might the price have been slightly different, but the bottom line is that site is a cracker, and we wanted it, and it's really great that it's got the existing resource consent on it at a sort of with the levels and style, it actually looks really good. So we'll make some enhancements to it and make some changes, and then we'll look to get it into the pipeline. You can see from the photograph we showed, it's really beautiful. I think that during these times, obviously subject to capital constraints, and clearly we'd be careful about committing to large cash outflows for land anytime, probably in the next sort of 6 to 12 months. There's lots of different ways we can deal with vendors to make sure that that they achieve what they want to achieve, and so do we. So we're still having land being brought to the board for review, actively so, and it's an important part of our growth. We're not pulling back on our long-term growth.
So, Stephen, we had a board meeting several days this week, and we had a good stream of bits of land coming in. I thought one of the interesting comments from one of the directors was, it's really good to miss out on something you want from time to time, because it reinforces to you that, in fact, you're not paying over the top, you know. Yeah. So, we do miss out from time to time, and it is a good thing. I've been at times thinking it wasn't such a good thing, but there you are.
Okay, and just maybe one final one. Just on debt levels, and appreciate this is an unusual period. We settlements that have, at least for a period of time, have been unusually impacted, and that has sort of pushed up net debt a bit higher than the market was thinking, certainly pre-COVID. But just gearing through 2.6%, just interested in how the board and management think about, a comfortable gearing ratio. I mean, are you comfortable up at that 45% level, or just give us a steer on how the company's thinking about managing the gearing ratio?
Yeah, got it. Look, the thing that we monitor the most closely, Stephen, is the composition of the debt. So the vast majority of it is around the land bank and the work in progress that we have at different sites. And obviously we have, timing differences where we invest in refurbishments at different villages and that sort of thing, or invest in Ryman. But the vast majority of it is purely work in progress, reflecting our land bank and what we're doing at sites. And given how much cash we free up each time we complete a village, that's how we get the most comfort from debt. And we do look at the amount of recurring income we get from resales, deferred management fees and care fee income, because obviously that provides good surety over servicing of debt, even without development margin actually. So that makes us really comfortable with our debt levels, because we know that we're only really incurring debt to make productive assets which will fundamentally recycle capital and create a very long tail of growing earnings. And that's one of the reasons why Dave, in his presentation, talked about even if we do nothing else, our existing portfolio will increase in annual earnings by about $100 million just from our current villages maturing without any further expenditure. And then with the overall rest of the land bank itself generating $4.4 billion, at that sort of 8% return, 350 million, wasn't it? The substantial amounts of recurring income that we're adding to our portfolio. And so we're happy to incur the work in progress required to do that. And of course, we are expanding into a new state. We do keep a careful eye on debt, of course. It's the right thing to do. And that's one of the reasons why we extended our syndication facility during March to 2.3 billion. And we have an incredibly supportive range of bankers. And as you'd expect, we are also and always looking at maybe one or two different ways through different debt type arrangements to diversify those funding lines.
Thank you. The next question comes from Jeremy Kincaid with UBS. Please go ahead.
Good morning, guys. Just following on from Richard's question, it sounds as though recycling capital is probably one of the most important things the banks are looking at. And so I suppose if worst case scenario sales did slow or dry up, what sort of levers would you be keen to pull first to encourage more sales? Would it be price, cash, incentives? Can you give us an idea on that?
No, I don't want to go into what our market reaction might be, other than obviously, Jeremy, we would be very mindful. And look, one of the things that I'd be really mindful of is making sure that we don't continue to build too much. Like if demand dried up, the most important thing would be to not commit to another apartment building if there weren't enough pre-sales going on, or if there weren't enough sold in the previous one. So I think that's one of the most important things that we do around managing our debt. And if we had we've obviously got land that we haven't committed to, I guess that's a potential. And fundamentally, the best way to just progressively over time sell units is to do a great job and to price them reasonably in the market so that people can free up capital. And I guess the graph that Dave showed earlier demonstrates that people have got pretty good headroom there, and also for service departments are incredibly affordable. So don't want to sound remotely complacent, because we're not. We're watching it all the time. If we needed to be a bit more responsive, then clearly we would be. But we see that the fundamental selling points of what we do and pricing units fairly so that people can free up capital is really our best strategy that we're very focused on.
And just also, we have that very strong forward book of $337 million worth of contracts. So we match that against our construction pipeline very closely, and we do watch that. And if you also look at our existing portfolio, our embedded sort of gains in there at the moment, $860 million worth of resale bank, but $440 million of accrued DMF as well. So there's another $1.3 billion of sort of pent up cash in the existing portfolio.
So that natural buffer that exists between what's realised from the sale of their home and what our pricing is really important. But I think, as Gordy's suggesting, the fact is that the vast majority of these people are in 80 or more, and they have a need. They have a healthcare or a supportive need, and so it's a needs-based decision. So I think that really means that people can make the decision, and because of the buffer, and they actually have a need that means they are not prepared to delay. So we've been through difficult real estate times in the past, and we've managed before, so I think that we'll be fine.
Okay. Second question, just on the value of contracts not yet settled, that jumped up a little bit this year. Was that a steady increase throughout the year, or did the jump up really occur because of coronavirus issues?
No, it was a steady increase during the year, and really represents the fact that we're pre-selling well out. For example, probably about 70 million or something of those related to the first couple of stages at Burwood East in Melbourne. And there's also some of it actually, I think 276 mil is stages that will complete by 31 March 21, and then the balance is actually going right into the following year. So we're sort of pre-selling well out actually, which is great. And our sales advisors have done a terrific job, well done guys, of making sure that our residents have been really well looked after during lockdown, good communications, and they're really looking forward to coming into those stages when they complete.
Thank you. The next question comes from Jeremy Simpson with Forsyth Barr. Please go ahead.
Well, good morning, guys. Hopefully you can hear me loud and clear. Firstly, yeah, well done on a good performance in terms of looking after your residents and your staff for this period. So that's great, and certainly a market leader and a sector leader and all that sort of thing, which is awesome. In terms of some questions, just not too many from me, but I guess I'm interested in I guess your current thoughts around margins, development and resales margins in this environment. Like year on year, they came back a little bit, but are still comfortably within the sort of target ranges. Is there any thoughts around the sort of near-term trajectory of those?
Yeah, look, I think with development margin, that was a very good year we have just had. So I would assume more development margin within the target range in the year ahead, in the sort of 20s to 25s, or maybe, in that sort of region. I think we've had a couple of years of really strong margin as we've had some exceptional villages come through. But look, we've got a broader range across 12 sites now, Jeremy, and I would expect the margin to just be more in where we would normally target. And we wouldn't see that as a negative. Probably the last just couple of years have been really good.
Right. And just on the construction side of things, any sort of initial thoughts around perhaps some opportunities around construction costs, given the outlook? There's a lot of activity still happening, but it doesn't look like there's a lot of follow-up activity, if you like, in terms of construction in New Zealand. I'm talking outside of the retirement sector. So any opportunities there, plus in Melbourne around construction costs?
Yeah. Well, look, it appears though, Jeremy, that the environment for building from a cost and also labour supply point of view may be quite good, over the next 2 years. It's always hard to predict, of course. Governments do things like commit to massive horizontal infrastructure projects and all that sort of thing, and you're not quite sure where the resource comes from. But certainly in residential and sort of mid-rise commercial, those are two sectors which look like they'll be under a bit of pressure. And look, that's the sort of work that we're going to be doing. So we're starting to see the first glimpses of perhaps a little bit of price pressure coming off. Certainly in the last 3 years, particularly in Auckland, there's been significant price rise pressure, as everybody knows about, and resource pressure. In Melbourne, it's been not as bad, actually. And so I'm not sure whether Melbourne will change significantly or not, but hopefully New Zealand will have more resource availability and perhaps at a more settled price. But it's early days, of course.
Cool. And just lastly from me, just on the regulatory/political environment in New Zealand, where do you think there's still a funding shortfall, I guess, particularly around nurses, and you've had some extra costs with COVID, clearly, and a little bit of extra funding associated with COVID, but how do you think the sector's tracking from a regulatory sort of lobbying perspective and the ability to perhaps get better funding, certainly around nurses, over the sort of near to medium term? Any sort of thoughts on how it's tracking?
Well, how it's tracked to date this year has not been very good. The sector wanted to receive around about $80 million, which was built up in a very detailed, specific way through the finance people in the sector, which was shared with the Ministry of Health officials, of $80 million relating to COVID. And the government funding response was $26 million, which I think worked out was about the same as 2 takeaway cups of coffee per resident per day over a 12-week period. So I would regard that, given the massive costs involved, I think that was very low, actually. But of course, there's more to come. There's a negotiation currently underway with the aged care related contract groups between the 21 DHBs and the aged care sector. And that fee increase, whatever it is, will be effective from the 1st of July. Don't know what that's looking like at the moment, Jeremy. However, there was nothing for aged care in the budget that I can recall. And so that's a shame, given that I think if this is probably a time where I think really aged care is shown to be an extremely effective part of the healthcare system and also really a cost-effective part of the healthcare system. So I guess what I hope for is that there's a better dialogue with the ministry, governments, DHBs, aged care, as it becomes a much more important part of how we deliver healthcare in New Zealand, and particularly with COVID sort of hanging around. So look, I don't hold out any massive short-term hopes, though, of any significant funding changes, I have to say, because I believe that would have probably been signalled in the budget if that was the case.
Thank you. The next question comes from Shane Foley with Harbour Asset Management. Please go ahead.
Good morning, guys, and I just have to echo the thoughts of the other callers. You've done a stunning job in what is a very challenging time, so congratulations to your team. I'd just like to understand a little bit more about if there is further COVID waves, how you would approach or deal with this. What have you learnt from the last few months, and how has it changed the way you would perhaps approach dealing with additional waves?
Okay, so the first thing we'd do, if there's additional wave, we would shut the villages down immediately. We would deploy masks and any interaction with residents immediately. All of our infection control procedures would be re-escalated. For example, if there was a new admission, they'd be admitted for 14 days isolation in their room. We would be insisting on COVID tests for any new admissions into aged care or service departments and ideally independent living units. And that's been a bit of a challenge with the DHBs actually, but the screening tests they introduced did help to make that more frequent. And I think we'd want to see more testing availability for staff, new staff, and probably randomised testing of staff. I think that one of the optimistic things from what we have been through is that we've learned that there's some pretty simple protocols that can benefit all of us, and even if you take about the complications of aged care, hand washing, distancing, wearing a mask. The World Health Organization has confirmed that mask wearing is a really helpful, good thing to do. Contact tracing, wearing surgical masks at least all of the time if you're caring for people. So there's a bunch of stuff that I think we now know, that we've got the equipment for, the resources, we've trained, reducing visitors. So I think we would move and be able to move really, really quick, and our residents would want it, just to make sure that safety factor was in place. Obviously, we're hoping we don't go back there, but you never know, do you? This is an unknown time. David?
Yeah, look, exactly. I think we'd go back, Shane, to exactly the situation we had previously, and we'd hope for some higher level of cooperation around testing of residents before they moved in and testing of staff. And, I feel a high level of anxiety after seeing the Television One news last night around the relatively loose arrangements that exist for people in quarantine. I just feel that this could jeopardise the COVID-free status that we have. So we are very aware of it.
We'd like to see more. The fundamental thing we'd like to see is more testing in aged care for new people coming in and new staff. Yeah. That would be great. And it's great we have the capacity for it, and we should be doing it. And actually we've been insisting on it, but it's been too much of a fight.
Yeah. So look, we're running out of time, but if we take one more question, and then we'll close.
The last question comes from Karen Jones Fowler with North Shore Corporate Nominees. Please go ahead.
Good morning, guys. Wonderful result under the circumstances. A couple of questions. I'm based in Australia, although a Kiwi, and questions relative from that perspective. Any intentions of obtaining a secondary listing in Australia?
The question was whether there's any intention to have a listing, a secondary listing in Australia. Look, we've talked about that, Nick, at times, but to date we haven't felt a need to do that. We're getting good volumes of trading, and so we haven't felt that's necessary.
So it's not something that we're actively looking at, and we haven't explored it for a long time.
Fine. Now, there was a Royal Commission on Aged Care in Australia. Was Ryman involved in that, and has there been any feedback from that Royal Commission?
Yep. So we submitted to the Commission at the start of last year by writing, and what we focused on was the fact that we don't believe that the aged care allocation round, where people are allocated free aged care bed licences, and then keep them, and potentially don't use them for a long, long time, and then if they decide not to use them, to make an economic gain by selling them, we don't believe that that is a very effective market for older people in Australia or obviously Victoria where we operate. For example, in the last year, we've paid 30 million Australian for new bed licences off providers who received those licences for free from the government and then sold them to us in an open market. Now, they're obviously very welcome to do that. From a resident point of view, though, you have to ask the question, what's the best thing for the resident? And I think the best thing for residents in any nation in relation to aged care is that new providers are encouraged to come in and innovate and to be able to provide their version of care which they think works, and for the consumer to then decide, to have the opportunity to make that decision. And I think that any licensing regime which makes it difficult for new entrants and which puts a financial barrier in place, as opposed to what the emphasis should be, which is purely around care provision and the ability to look after people well. We fed back to the Royal Commission yesterday, in fact, Dave and Shane and Paul Sutton, that those were our main points of feedback, really, that we think that the bond system, the way that the licensing works, really needs to open up to encourage innovation and new players and let consumers decide what they would prefer.
In a bigger picture sense, Nick, I think that fundamentally we would welcome anything that raised the standards of care and the reputation of the sector, because some of the stories were pretty harrowing to read that the Royal Commission have presented. We sort of looked carefully at how we perform against some of the recommendations that have been evident from the Commission, and our staff ratios are in excess of what they're talking about anyway. So, look, it's probably damaging to the sector's reputation, and that's not good for anybody. So we want to engage and want to see some outcomes from it. Look, I'm sorry, we're probably out of time now, so if your questions haven't been answered, then we'll get back to you. And it's really my role to thank you for your time and for giving us your attention today. As I've said, what a year. We look forward to reporting back to you in 6 months' time. So thank you very much. Goodbye.
Thanks, everybody. Thank you. Catch you later.